Regulation T margin versus portfolio margin. Which one should you use? In this video, you're going to learn which type of margin is best when trading options. Let's get started. Before we get started, please subscribe and click the notification bell. Regulation T is available for accounts that have a minimum balance of around $2,000. When you sell naked options using Regulation T, it's going to reduce your buying power by anywhere from 12 to 20%. As a result, let's say you sell one contract with a strike price of $100. That means that the notional value of that contract is going to be $10,000 because the $100 strike price and one contract equals 100 shares. And if you're trading Regulation T, then your buying power reduction is going to be anywhere from 12% to 20% of $10,000, which means it's going to be reduced by $1,200 to $2,000 for every contract that you sell. In contrast, portfolio margin, which is usually available to accounts with an account balance or net liquidation value of around $150,000 or more, will usually reduce your available buying power by around 4% to 10% of the maximum loss. So using the same example as we did previously, instead of reducing your available buying power by $1,200 to $2,000 for every contract that you sell, by using portfolio margin, it'll reduce your available buying power by about $400 to around $1,000 for every contract that you sell. Portfolio margin stress tests your entire portfolio in aggregate. As a result, the further out of the money options that you sell, the less your buying power is going to be reduced. So again, PM or portfolio margin looks at the risk of your entire portfolio. In my opinion, if you have an account balance of over $150,000, and I think that that number varies for each brokerage, whether it be E-Trade, Schwab, or Interactive Brokers, then I would definitely recommend always using portfolio margin. Portfolio margin is great, especially when you're disciplined, because it enables you to sell further out of the money options. I remember when Amazon fell below $3,200 in late September and early August of 2021. And during that time, I was selling put options in Amazon with a strike price of $2,200 or $2,300, and my buying power was only being reduced by a few $1,000s per contract, despite collecting around $300 to $400 for every contract that I was selling. Portfolio margin allows you to make less risky trades and increase your win rate without significantly reducing your available buying power. You can literally sell further out of the money options and collect premium on trades using portfolio margin that you would not make when using Regulation T, because the amount of buying power that is going to be used up when trading with Regulation T might encourage you to be more aggressive with your strike selection so that you can collect more premium. Additionally, when you're trading using portfolio margin, when volatility is low and when the VIX is trading below 15, you might be more likely when using portfolio margin to trade further out of the money and trade naked options as opposed to using vertical credit spreads. One major drawback of using portfolio margin, especially when trading naked options, is that during a large volatility expansion event, your excess liquidity has a tendency to drastically decrease. As a result, it's very important to always make sure that you don't trade too large and that you always leave an ample safety net so that you do not get hit with a margin call if the market pulls back by 15 or 20%. Because if the market does pull back by 15 or 20% and the VIX increases from 15 to 40, then you don't want to run out of buying power and be forced to close out positions at the most inopportune time. David Jaffe with BestStockStrategy.com. Please subscribe and click the notification bell. Leave a comment below and let me know your thoughts on whether you would prefer to trade using portfolio margin or whether you would prefer to trade using Regulation T.